Welcome to the What to Watch video update. This has developed into a weekly video. I do a lot of different videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. I do a thing called a deep dive video where I talk about charts that really I didn't discuss in any of the videos this week, just in case we're getting some insight from those. And then the very last video that I do is I really hone in on what I'm watching as of right now. This has developed into a weekly video. When I first came up with this idea, I was going to update it on an as-needed basis, but ever since I've been doing this video, I've only been able to really do it once a week. So that's kind of what it's developing into. This is being prepared for Monday, May 6th. Now, the first thing that I look at are all those charts that are positive. Now, some of these, I have a positive list and a negative list. Some of these could go on either list right now because we're right at a tipping point. We're dealing with the 50-day moving average, simple moving average, not only for the S&P, but across a number of different indexes right now. And that's pretty much the line in the sand between positive and negative for the intermediate term. We're looking better in the short term, but we haven't quite turned positive. We're still positive in the long term. And we're trying to see, can we turn back and look more positive in the short and intermediate term? And we're going to be watching that play out. Now, in the upcoming week, we don't have a lot of economic reports that are coming out like we've had over the last couple of weeks. So the market doesn't have those to really key off of for this week. I mean, there are reports, but they're not as influential as the reports that we have been seeing. So we'll have to see. Are we going to chop sideways and not really make a decision this week? Or are we going to break to the upside and turn more positive, or break to the downside and turn more negative? The first area that is looking positive as of right now. Now, this is as of the weekend before the upcoming week. And this can change quite fast and very easily because some of these indicators are quite volatile. This is measuring sentiment. Where we had been looking more negative is where we're coming down. Now, we tend to use this as a contrarian indicator when we get to 75 or above. That means that folks are a little too complacent and maybe too positive. Then when it turns and finally starts to break and go lower, then we go with it. We don't really turn positive until we drop down to 25 or below. Now, we've not dropped down to that level yet, but we have been bouncing up. Then we came down and we're starting to go back up a little bit. So I'm treating this as positive for right now because we had a pretty solid up day on Friday. Another thing that is looking a little bit more positive and showing some improvement is the VIX. And this is a fear gauge. And I have a line chart in the middle area and then a bar chart down below. When stocks are going up, fear decreases in the market and the VIX goes down. And this is pretty healthy right now. We're coming back down into an area where we were at when we saw more strength in the market, both with the line chart. And then this is the bar chart to show you the whole range for that particular day. Then this is a little bit concerning, though. This is a VIX of the VIX. It's an indicator of the VIX or the volatility of the VIX. And this is getting to a really low reading, meaning that volatility in the VIX is really dropping off. And this typically happens when the market's going up. And you can see here when we've had really low readings, both with the bar chart and the line chart, sometimes that kicks volatility back into gear. Doesn't necessarily mean negative, but usually it does. If volatility is picking back up, that typically means that we're going down. So the fact that we're getting a really low reading right now is a little bit of a concern. But until we actually see that happen, we're taking this more as positive. We're showing some improvement intraday, not end of day charts, but on an intraday basis between growth and value. With the up move that we've seen, the blue line is back above the red line. So that's showing some improvement. And we want growth to do better in a more positive environment. When the red line is on top, that means value is outperforming growth, and that tends to not be as positive for the market. There's another ratio between growth and value for the S&P. We had really been coming down as the market was under pressure. We were showing some improvement only to fall back. But then in Friday's session, we really spiked up. We're not necessarily positive yet, but we are showing some improvement here. Then we look at a daily chart of just the S&P. This goes back, I believe, 3 years. And we're right on the 50-day moving average. We're not above it. We're not below it. We're pretty much right on it right now. If we break above that, that would be positive. If this acts as overhead resistance and we fall back down, that would be more negative. So this is the real critical area that we're watching, but we're not just dealing with this with the S&P 500. There's other areas of the market that are also dealing with their 50-day moving average. We're also looking a little more positive with the advanced decline ratio. We're above 0 and going up, both with the blue line and the red line. So this is showing an improvement. We're also seeing a little bit of an improvement with the advanced decline line. There are more stocks going up than going down based on price as well as volume, but we're not getting a lot of confidence from this chart. This chart is giving us a little bit more confidence. This is looking at new highs versus new lows. And when we were going down with the S&P, we contracted with the new highs, but we really didn't expand with the new lows. That was something positive that we were noticing here. And then as we've been bouncing back up, we're seeing the new highs start to kick into gear. And then in Friday's session, actually spiked up a little bit, enough so that we have a 5-day moving average of the new high versus new lows going up, and a 10-period moving average also going up. So this is an internal measure that's still hanging in there for right now. Accumulation distribution is right back up to its moving average. This is positive because we had been negative and we're coming right back up to this red line. This uses volume in how it's calculated. This is also supposed to be a smart money indicator. You can see when we were above this red line and going up, that's when we really saw the upward strength in the market from the beginning of November up until about the middle or so of March. And then we started to run into some problems. If we can get above this and stay above it, that would turn things much more positive. So it's right on the fence right now, but I put it positive because we're coming up from a lower reading. Then we look at the moving averages. Now, these are calculated just on the S&P 500 index itself, not the stocks inside, but the price of the S&P 500. The 20-period, 50-period, and 200-period are turning back up, not showing an awful lot of strength right now, but the fact that it's going up is positive, that all of these moving averages are. We're crossing back above 50 with the percent of stocks. Now, this is inside of the S&P, of those stocks that are above their 20-period moving averages. And that's crossing back above 50. So in the short term, we're turning more positive. The only problem is our 20-period moving average is below the 50-period moving average right now. So we're crossing back above that. We still have to go above the 50-period moving average. But in the short term, this is turning more positive. Now, in the intermediate term, here's the 50-period moving average study. Those stocks in the S&P that are above their 50-day moving average, we're coming up, but we're still below 50 here. We do need to see some improvement from this chart. And we go further out with the 100-period moving average study. This is going back up and is above 50. So that's more positive in the intermediate to long term. And then our long-term chart, the 200-period moving average, this is going back up and still hanging in there for the most part. Then we look at a double and triple exponential moving average based on 20 periods. And that's what this blue and green line represent here. And we're breaking above that. So this is showing some improvement here. We look at a regular 20-period simple and exponential moving average where we're breaking above both of the lines. So in the short term, we're looking a little bit better. This is where we start to run into problems. We're above the 50-period exponential moving average, but we're right at the 50-period simple moving average, which is what most folks use. And we closed right on that. We can get above it, that would be positive. If we come back down, we've come up to this level before only to bounce back. We'll see. Can we get some thrust to go up above that? So this is one thing that I'm really watching. We're also keeping an eye on the 100-period moving averages. Not that we're there, but just that they are providing support. And we're above that, so that's positive. If we do see some weakness, we'll be watching these moving averages. And then here's a whole spaghetti mess. I call it a moving average tree, where we're getting above the 20-period moving averages, but we still have yet to get above the 50-period moving averages. And then the 100-period moving averages are down below. So this is everything plotted on one chart. The parabolic SAR on the daily chart is positive. We have the dots underneath. Now you're going to see later that the weekly chart is still negative, but in the shorter term, we have turned back to positive. We're still holding up with support with the Ichimoku cloud. We came right down to the lower end of this green cloud, and so far this level has been holding up. If we see more downside, it would be even more positive if we could break out above the cloud and continue to go up. The S&P 500 McClellan oscillator has crossed back above 0, so that's turning positive. And when this is above 0, the next chart that I show after this is the summation index. When it's above 0, then the summation index is positive. When it's below 0, the summation index is negative. The McClellan oscillator is short to intermediate term, where the next chart, the summation index, this is more intermediate to even somewhat long term. And we're starting to turn back up based on price, so that's positive. And we're looking a little stronger here based on volume. Now, these are two completely different indicators. They're calculated totally different. I just plot them on the same chart to try to get a comparison here. So we're not necessarily positive. We haven't crossed above zero with volume, but we are going up, and it's a little more convicted here in its upward move than what we're seeing with price. And this could be that volume is leading price. We also have a thing called the Swenlin trading oscillator, and there's a lot of indicators that I use that were developed by a gentleman named Carl Swenlin, and naturally, the Swenlin trading oscillator was created after him. It's a momentum oscillator that I look at later. This is called a trading oscillator, where we had been going up while the S&P was still going down. And that was something positive we were hanging on to. But then as the S&P was bouncing, we saw the Swenlin trading oscillator starting to go down. So that was a bit of a warning sign. Well, now we're going back up based on price, and we're starting to turn back up with the Swenlin trading oscillator based on price and volume, and we're above zero. So for right now, this is looking more positive. Then we have the bullish percent index, and I like this indicator because it's not moving average based. This measures the point and figure buy or sell signals inside of the S&P. When this is going up, more buy signals are being generated, and that's what's happening right now when we're above 50. So this is actually positive. Then we look at the long-term trend, and this is a weekly chart of the S&P, and I have a 13-week, that's in blue, and a 50-week, that's in red, to show the really long-term trend is still up, and we're just coming back up to the 13-week moving average. If we can break above that, that would turn things more positive. Then we look at more of the broad market from here in the positive section going forth, where we have some advanced decline line studies. We look at the NYSE common stock, which is breaking above the moving average, so that's turning positive. The S&P is showing improvement, the mid caps are showing improvement, and even the small caps are showing some improvement. We want to see these all continue to go up if we're going to remain positive. Then this is a measure of the new highs minus the new lows on the NYSE. When we're positive, we're above zero. When we're negative, we're below zero. We are bouncing back up after we had dropped below zero. Now we're coming back up and showing more positive readings here. So this is turning more positive as well for the broad market. This is the same principle that I talked about with the S&P McClellan oscillator. This is the NYSE McClellan oscillator. So it takes a look at the broader market. This is above zero and advancing. So when we look at the summation index based on price, we're turning back up, and we're also starting to go up based on volume. So we're seeing some improvement here. The NYSE bullish percent index never did get down to 50 or below. It always stayed positive, even though it was declining. Now it's ever so slightly starting to tick back up. So that is positive. And these are high leverage loans. This is an ETF of very risky loans. And if the market was going to get ready to fall apart, or if the economy was going to get ready to fall apart, there are very smart people that invest in this ETF who really know what's going on. Do you think we would be going up the way we have been? We haven't even come down to the 50-day moving average, barely, and then we bounced right up off of that. This is still in a really solid uptrend and has been in an uptrend for pretty much all of 2023. So this is giving us some confidence that folks that really know what's going on in the market are not necessarily freaking out about what's going on. The financial sector is coming right back up to its 50-day moving average. Now, longer term, it's still in an uptrend. And then this is a chart I've been talking about literally for months. This is a weekly chart of the S&P 500, and then I have pivot points. And the cool thing about this, the pivot points are put on this chart before we get there based on time or price. And I said before mistakenly, they last for the month. No, they last for the whole quarter. And so we can see these lines well before they even come into the picture. We had finally broke above this, and it was looking more positive. Then we came back down below it. That was turning things more negative. Well, in Friday's session, this is about 51.10 to 51.11. We closed at 51.27 on Friday. So we're just a few points above that. And this being a weekly chart, to have this close pretty much at the high on a Friday above resistance, that can be taken as positive. The mid caps, also one of the stronger areas. They've been holding up fairly well, especially since the end of January, right at its 50-day moving average. The NASDAQ is a little bit above its moving average, its 50-period moving average. So this is showing a little bit more strength right now. And then we look at a broad market measure with the Amex, NASDAQ, and NYSE, and we take a 5-period moving average of the highs minus the lows. We're starting to cross back above zero where we had gone negative. So this is turning more positive. Here's a large cap growth ETF. We're just a little bit above the 50-period moving average here. So that's a little more positive. Mega cap growth is coming back up to the moving average, but hasn't broken out above it yet. These are the big Magnificent Seven stocks and other really, really big stocks. The Wilshire 5000, a broad market measure, right at its 50-day moving average. Total stock, US stock ETF, which is 2,651 stocks, right at its 50-day moving average. You can see how this stuff all lines up. And then the FANG index is actually above its 50-day moving average. These are the bigger stocks: Facebook, Apple, Amazon, Netflix, Google, and NVIDIA, and all the other big ones you can think of. They're actually outperforming a bit right now, and so they're showing a little more improvement. We're still in a longer-term uptrend with the FANG index and now going back above the 50-day moving average. And then we look at a ratio between the S&P 500 and 3 to 7-year bonds. This has been going up. And when this happens, the market is anticipating a soft landing, meaning that after seeing economic weakness, we're not necessarily going to go into a recession. If we come down here to a hard landing, that means that we'll probably go into a recession. Well, as the market had been pulling back, we were coming down into this rainbow, but now we're starting to show some improvement. If this continues to go up, it will break out above the rainbow, and we want to see that continue to turn more positive. This is a weekly chart of the NASDAQ 100 where we're coming right back up to this long-term trend line going back to 2009. We had dropped below it, but now we're starting to come back up to that line. Here's a weekly chart of the S&P 500 going all the way back to 1987. This trend line, we're still above it for right now. And if we continue to come down, it may end up providing support. But right now, we're still above that line. We look at a ratio between the NASDAQ 100, which is growth, and the Dow, which are more value stocks, the best of the best. And when we take a ratio, we're just right back up to this all-time high reading. Now, to give you some context to this, this is a very long-term chart. Way over here on the left, when we were really going up, this was the dot-com boom. And then when everything fell apart in the year 2000, this is the dot-com bust. And then 9/11 happened in there and everything was just terrible. And it took many, many years for us to get all the way back up to the same ratio. Right at the end of 2021, that's when we topped out. And then we went into 2022, which was a very difficult year for stocks. Since then, we've been coming back up and we're right about at this line. Now, you could say, is that negative? Well, it could be, but if we break out and actually exceed this previous high, that would be more positive. Then this is a very similar type of study where we take the QQQs, the NASDAQ 100, with the small caps, and we're not at the blue line here. We're just a little bit below it. But the perma bears, they're waiting for this previous chart and this chart to start falling apart, and they're not doing that yet. We want to keep an eye on the 10-year yield. Interest rates are still pretty high right now, but they're starting to come back down. When this goes down, that means the 10-year yield is going down. If this can continue to fall, that right now would give more support to stocks. And then we don't know if this is going to be legitimate or not. We have a thing called the ZWAG NYSE breadth thrust. And I don't know if this is going to happen or not because we actually have passed the window for potentially seeing a new ZWAG NYSE breadth thrust. But I don't get the data for this for Friday until after the close on Monday. What we need to do is come all the way up to this red line by May 3rd, which was Friday, to generate a new ZWAG NYSE breadth thrust. If we didn't do that, then this window closes and there's no trigger that's been signaled. So I'll deal with that. Even though we had an up day on Friday, I don't know if it was strong enough to really bump this signal above the red line. So I won't really discuss it unless we do generate a signal. Now I have some things to look at that are more on the negative side. Now, some of these charts, you could switch over to the positive side. One of the things is the equity put call ratio. When we see this going up, that tends to be more negative for the market. And when it's going down, that's more positive for the market. We're starting to go back up, which could be negative for the market. Then we look at small cap growth versus value. Now, I showed you some intraday charts. These are end of day charts where we are bouncing back up, but we need to show a lot more improvement with small cap growth versus value. We also need to see more improvement with mid-cap growth versus mid-cap value, and we need to see more improvement with S&P growth to value. So they're bouncing up, but we need to see even more strength than what we're seeing. This is an ETF, growth versus value, where I could have put this on the positive side. We came all the way down to this 250 period moving average, and we've been bouncing up off of that, but we're still inside the rainbow. If we can get back up and go above this rainbow, that would turn things more positive. And then we look at discretionary versus staples. I mainly focus on the chart down below, which is a ratio, and we're bouncing back up off the 200-day moving average with this ratio, but we're not showing an awful lot of strength right now. So and a lot of this has to do with weakness that we're seeing in Tesla, combined with some strength that we've been seeing in staples, which are more defensive areas of the market. Then I have some growth to value ratios that we look at here. The Qs to S&P, yeah, we're coming back up above the moving average, but the moving average is still going down. We actually declined with discretionary to the S&P back down to the moving average, and we saw a little bit of an improvement with large cap growth versus large cap value, but we want to see the moving average turn back up. So we look at this for the large caps showing some improvement. We're turning back up. It's still below the moving average with the mid caps and turning back up and below the moving average with the small caps. So we need to see them, all of these charts, climb above the moving average and then see the moving average turn back up to be more positive. Then this is another reason why I'm basically concluding that we're negative right now. For the types of strategies that I teach about and I implement, I teach that if we're in a trend, you do one type of strategy. You do directional strategies. When we're not trending, then you do sideways types of strategies. And I use the ADX to help me determine whether we're in a trending or non-trending environment. Because most people are either long or short. And if they do have a third thing, it's their money sitting in a money market and they're figuring out what to do next. Well, I like to take advantage of all three kinds of climates because we can be in them for lengthy periods of time. The black line going through this chart is called the ADX, the average directional movement. When this is going down, that means the trend is weakening. I put a 5-period moving average on here to give it some context, and we're dropping below the moving average. Okay, so it's a weakening trend. But from a static number perspective, we're above 20. When we're at 20 or above, based on the S&P 500, it may be 25, 30, whatever, if you use this for stocks. What I found over the years is 20 works pretty good for the S&P 500 index. And when we're above that, we're still in a trending environment. If we drop below 20, then we're in a non-trending environment. Well, we're still above 20, even though it's a weakening trend. Then the next thing I look at is which line is on top, the red line or the green line. The red line's on top, so that's negative. Even though it's declining, the green line's below, but it has been improving. What we want to see is the green line cross above the red line and then see the ADX turn up and go above its moving average. That would turn things more positive from a trending basis. Until then, we have to conclude that the trend is negative. Then we're also still negative when we look at our momentum oscillators. You remember Carl Swenlin that I mentioned a little while ago? He developed the price momentum oscillator. And then on the next chart after this, I have a lot of studies that go with this indicator. And it's like a MACD. It's like any other momentum oscillators that you might use, where we're still negative. We're trying to turn back up, but we're still below the moving average when we look just at the PMO itself. But we're starting to look a little more positive if we break it out based on price, and we're turning up barely. It's probably really hard to see, flat to going up slightly based on volume. So this is showing some improvement. Then these are the studies that go with that, and these are based on stocks inside of the S&P 500. How many of the stocks in the S&P 500 have rising PMOs? That's starting to go up. How many are producing buy signals? That's starting to go up. How many are above zero? We're pretty much flat, but trying to turn up a little bit after we had been declining. Then we look at a 50-period double and triple exponential moving average, and we're still below the blue line here. This is the double exponential moving average. We were able to get above the triple, and that tends to move faster. This would be even more positive if we could close above both the blue line and the red line, see these lines turn back up, and actually see the red line cross above the blue line. That's what we were seeing when we saw the really solid uptrend. Until that happens, we pretty much have to default to negative unless we break above this and close above the blue line. Then we can switch slightly more positive. Then we look at the Chaikin money flow. This is another smart money indicator, an oscillator, where it's negative right now, but it's trying to improve. It was showing more improvement, and then we had a down day kind of blew that out of the water. Now it's trying to come back up. If this continues to go up and eventually turn green, that would be more positive. And this moving average here, if that continues to go up, that would be more positive as well. But for right now, it's negative. The parabolic SAR weekly chart continues to be negative with dots on top. Now here's the slope oscillator, and I have a number of different oscillators that I use. I have short, intermediate, and long-term. This is a short-term oscillator. It's about our touchiest oscillator that we use, and it's really doing something where the other ones are just kind of figuring out what to do. We're extreme negative. Now I put this red line on here, but when we get down to this level, this usually means that we're going down a little too far, too fast. We're starting to turn up, and we've crossed above the moving average, and we're actually crossing above this red line. This isn't positive yet. It won't be positive until it crosses back above zero, but this is showing some improvement. Then we look at a MACD. For a lot of folks, this is the first oscillator that you learn about. It was the first one I learned about decades ago. We're starting to turn back up above the moving average. If this can keep going up and then cross back above zero, then that would turn this more positive. And then here's all of the oscillators that I look at. The top two are short term, and they're looking a little better. Then I have three that are intermediate term, the MACD, the PMO, and the PPO. They are showing some improvement, but not turning positive yet. And then I have a TRIX and a KST. Both of those oscillators are longer term. We're turning up a little bit with the KST, but we're not above the moving average yet. And we're just kind of starting to turn with the TRIX. For us to turn more positive, we want to see all of these turn positive and all be going up. Then we look at a thing called the vortex indicator. And this is pretty hard. This is pretty easy to interpret. The red line's on top, so we're negative. Now, it is going down and the green line's coming up. We would turn more positive with this chart if the green line crossed above the red line. Then this is an indicator that I developed decades ago for a trading system, and I stopped doing that system, but I kept the indicator. This is a mini rainbow, and all it is a 20-period simple moving average of the open, high, low, close. When we're above this and then falling back, a lot of times this mini rainbow, a line in here, may provide support. Well, we're dropping below the mini rainbow, and sometimes this will provide resistance. We have not necessarily cleared the rainbow yet. We're a little bit above it, but we want to get above this and then see the rainbow turn back up to be more positive with this chart. And we have the NASDAQ 100 right up to its 50-day moving average. So, and the stocks that are in the S&P 500, there's also stocks from the NASDAQ 100 there too. So if we can break above the 50, now you notice that the NASDAQ was already above its 50-day moving average, but the NASDAQ 100, which has been outperforming the NASDAQ, it's just at its moving average. So it's actually lagging a little bit behind right now. And the stocks that are in the NASDAQ 100 are also in the S&P 500. Then we're seeing the momentum for the NASDAQ 100. It's still negative, but we're starting to turn up and cross above its moving average. This will turn more positive if we cross above zero and keep going up. This is the bullish percent index for the NASDAQ 100. It had become very extreme negative. We're bouncing up. We're still negative since we're below 50, but we are showing some improvement with this reading. And this is showing us the point and figure buy or sell signals inside of the NASDAQ 100. Then we look at the Dow, right at its 50-day moving average. The tech sector, a little bit below its 50-day moving average. The semiconductors, a little bit below its 50-day moving average. The QQQs, actually a little bit above its 20 period. No, yeah, that's right. It's 20 period, but we're still below the 50-period moving average here. And then we keep an eye on the staples to tech ratio. When this is going up like it was in 2022, that means staples were outperforming tech, and that was a difficult year for stocks. When this ratio is going down, that means staples are underperforming tech. Well, that's what they've been doing, but then we saw this spike up, and we're coming up to this moving average. We're starting to fall down, but we haven't really seen a real decline with this ratio yet. We want to see this ratio continue to go down if we're going to turn more positive on the market. Until it does that, we have to look at this more in the negative view of things. Then we look at 1 to 3 month T-bills, which you could pretty much call cash, and compare it with 3 to 7 year bonds. When this is going up, that means cash is outperforming 3 to 7 year bonds. Can you believe that? Well, then we went through a period of time in October when this ratio really started coming down. They thought interest rates had topped out, that the Fed was going to start cutting rates. The stock market started really going up strong. Well, then that whole scenario kind of got thrown out the window, and we've been seeing this ratio going back up. But right now, we're starting to come back down. Now, this is still negative. We want to see this continue to fall and eventually get to the point where we see a death cross with this ratio to turn more positive. This is a similar type of study. We look at 3 to 7 year bonds and compare them with stocks. When this ratio is going down, that means bonds are underperforming. Well, lately they've been bouncing back up, but now they're showing a little bit more weakness. If they could continue to go back down, that would be more positive for the S&P 500. And then we look at the tech sector and compare it with bonds, where it's showing some improvement, but we're inside the rainbow, but we haven't broken out of the top of the rainbow yet. So it's still negative, but showing an improvement. We look at 1 to 3 year treasury bonds and compare them with 3 to 7 year treasury bonds. When this is going up, that means the shorter term bonds are outperforming because we're in an interest rate rising environment. Then when this is coming down, folks think that maybe interest rates have topped out. Now we've been going back up, but you see over here lately, we've been starting to come back down. We need to see this continue to decline if we're going to turn more positive concerning interest rates. We look at the QQQs and compare them with 3 to 7 year bonds, fell back as they were under pressure, but now showing some improvement, but still inside the rainbow. These are tips. These are Treasury inflation protected securities. And in a rising interest rate environment, this is what you want to be in because they're shorter term and they adjust for inflation. And so you get higher yields with that. Instead of locking your money up for 7 to 10 years, where you might be getting 3%, well, in the market, you might be getting 5%. So folks tend to get into these tips in a rising interest rate environment. You see how we came down in October? Folks thought rates had topped out and we're going to start coming down. Now we're starting to go back up, but over the last couple of days, this ratio has been coming back down. We want to see this continue to fall for things to be more positive. And we look at home construction, a very interest rate sensitive area of the market. Fell back as the market was under pressure, starting to bounce back up, but still inside the rainbow. The broad market, not just the S&P, but we're looking at all stocks. We have a couple of different broad market measures here compared with 3 to 7 year bonds. Showing an improvement, but still inside the rainbow. This is the S&P 1500, another broad market measure, showing some improvement, but still inside the rainbow. And then we look at staples, the S&P 500. When this is going down, that means staples are underperforming, and that tends to give a lot of support to the S&P. We really spiked up, and we're not starting to come down with any conviction, even though we are falling a bit. We want to see this go back to declining to be more positive. Then we look at the dollar, which has been strong. It got up into the 106 range, but now it's falling back. We're into the high 104s now. If the dollar continues to fall, that could be positive for stocks. But since we're still in an uptrend on this daily chart, that's still negative for stocks until proven otherwise. So thank you. I really hope you found this helpful. Please, if you want to hear about updates to these charts, watch the daily videos. I hope you have a very good weekend, and I will talk to you in the next video.